back about 3.5 million units. Actually, that chart's about 12 months old. The current number is over 4 million units. So 3 million units taken out in the downturn, we've added back 4 million units. Now, for an industry that tends to sell what it can make rather than make what it can sell, adding too much capacity back can put a little bit of pressure on pricing. So that's something we're very closely looking at as well. The third C is currency. And when we talk about currency, we primarily refer to the Japanese yen. The Japanese yen has depreciated from about 78 to the dollar a couple of years ago to 120 to a dollar today. Why is that important? Simply because every yen to dollar depreciation adds about $100 of incremental profit per car to the big three Japanese, and about $200 of incremental profit per car to the smaller Japanese. So with the yen move we've had so far, Toyota, Honda, and Nissan get about $4,000 of incremental profits per car and $8,000 for the smaller Japanese. I don't need to tell you that that's obviously a massive, massive number. And that includes cars that are made here. For instance, if you took the value of all the Japanese branded cars that are sold in the USA, about 44% of that value is actually yen denominated, about 50% if you take profits as well. So the yen is a very, very big factor here. We expect the Japanese brands to plow the benefits of the yen back into making some gorgeous cars that go on sale starting next year, and we think this could put price pressure on the Americans and the Koreans. So just to summarize, if you look at the easy credit environment we are in right now, the excess capacity that's being added, and potential price competition from the currency, in a way the industry kind of looks like it did back in 2006, where despite the high level of sales, there could be some pressure on profitability. I want to touch on gas prices as well, because it's obviously a very big theme right now. Here again, there's good news and bad news. The good news is that it's obviously dollars in the consumer's pocket. Again, it's not going to get someone who was not going to buy a new car to buy a new car. It's not going to get someone who was going to buy a Ford Focus to trade up to a Ford Expedition, but it will certainly help in terms of trim levels or optional equipment in terms of driving an upgrade cycle. The flip side of that, of course, is that a lot of the US economy depends on the oil and gas industry. And obviously 50% price in the decline of oil is going to have some kind of adverse macro impact. What this chart shows you is that miles driven and gas prices are positively and not inversely correlated. So the US GDP actually is a bigger driver of demand than gas prices itself. So we'll have to see what the macro impact is in addition to the little bit of a tailwind that the consumer gets. Now, obviously, luxury here is a theme, so I wanted to touch on that as well. We think it's a very exciting time to be a luxury brand in the US. Now, if you go back to, again, past cycles, luxury is obviously counter-cyclical. It does better in a downturn, and it does and loses share in an upturn because the mass market is obviously more economically sensitive. But that hasn't happened in the last couple of cycles. As you can see, luxury share kind of hit a high level around 2005, 2006 or so, and it's kind of stayed there. It's a little unclear as to why that's happened. One of the reasons could be incentives. As you can see, around the same time that luxury share kind of stayed up at those high levels, luxury incentives really broke away from non-luxury incentives. One of the factors here could be FX, because a lot of luxury cars are still imported. One of the factors could be the luxury brands coming down closer to a mass market price point. But going forward, we expect the luxury brands to pick up more and more share. It's an interesting fact that the average transaction price of a new car in the US today is about $33,000. Every single luxury brand has a car that starts at about 10% below that price. I think that's the first time that's ever happened, and it really shows that the luxury brands really want to make inroads into the mass market as well. So moving to other regions very quickly, Europe, as I said, continues to bounce along a bottom. Most of the industry and the macroeconomic experts we speak with think that things are fine right now, but basically ask me tomorrow, ask me the day after, things could fall out of bed very, very quickly. Our European team certainly believes that the European market is going to look more like Japan going forward, where if you look at the miles driven, the demand demographics, the income demographics, all of those look fairly negative. So we only expect very low single-digit growth CAGR in Europe going forward. Moving on to China. China obviously has been the fastest growing market in the auto industry for a long time. That will continue to be the case, but that growth level will moderate to something like high single digits, low double digit levels. Now, while that seems like it's going to stabilize at that level, we do get data points or developments every so often that tends to give the industry a little bit of jitters. 6 months ago, we had the NDRC investigations into price fixing on the spare parts side for the OEMs. A few weeks ago, we had the OEMs who were all forced to give bonuses to their Chinese dealers to make up for lower levels of volumes. So the demand situation in China should remain fairly stable in the high single digits, but if there is an inflection from that level, it's likely to be an inflection lower rather than an inflection higher. Now, before I hand it over, I want to also speak about some of the longer-term secular trends we're seeing in the industry. We like to say at Morgan Stanley that in the next 5 years, we think the automobile as we know it will change more than it has in the last 100. And this secular change is being driven by a number of factors. It's fuel efficiency, it's safety, it's emissions, it's connectivity, as mentioned previously, and also autonomous cars. Now, when we mention the topic of autonomous cars to an investor base or to the industry, there's still a lot of eye rolling and snickering as people still think this is an era of science fiction. But we at Morgan Stanley are very big believers in autonomous cars. We think self-driving cars are going to be here sooner than you think, probably before the end of the decade. And the technology to do that is already here. And when autonomous cars do show up, it's not just going to be another cool new feature added to the car, like say an infotainment system or LED headlights. It's going to bring a lot of disruption because the car as we know it today is primarily a hardware device. I'd say 90% of the value of the car comes from hardware. An autonomous car will probably get about 60, 70% of its value from software. So the auto industry today is very good at beating metal into shape and engineering hardware, but they need to learn a brand new skill set, which is writing code, which also means that the auto industry will have to compete with the Apples and the Googles and the Twitters and Facebooks of the world for talent and have to get them to move to sunny Michigan from Southern California, which is going to be a real challenge. So some players in the industry will thrive going forward. Some of them will struggle with the change. We think the auto industry 5 years from now looks a lot more like PCs or smartphones, where you have some players that want to be the Apples of the auto industry, that design the hardware, develop the software, and control the content. Some automakers are like the HPs and Dells of the world, where they're just low-cost hardware manufacturers, and they put in operating systems that are made by other people, kind of like the Microsoft of the world. Those could be suppliers, those could be other OEMs, those could be people like Google who enter the auto industry from Silicon Valley. So as the auto industry changes going forward, there's going to be a lot of disruption, and that's something we really want to keep an eye on. So just to conclude, I'd say the overall take is